everybody, welcome. My name is Diego Mello with StrataVentures. Every other Monday, we hold an industry webinar when we bring in a particular topic or we bring in speakers that shine a little bit of light to this industry, because I know everybody has questions. This evening, we're going to be talking about rehabbing new builds with the exit strategy to a rental property. So there's going to be a lot of key points that it would be great for you guys to write down notes. Maybe if you have questions after that, we'd be happy to work with you guys on a one-on-one manner, because that's what we're here about. We're here to help people understand what they're doing, and most of all, get to know us a little bit better and see if we're ever going to be a good part of your success here. So give me 1 second here. I think we've got, yep, there we go. All right. Sorry about that. All right, our topic information this evening, guys, we said it was going to be rehab and new build to rental. And then around 7:10, we're going to open it up to attendee questions, Q&A, because guys, that's what this meeting is about. Those of you that are using Zoom for the first time, there is a Q&A section where you can ask your questions and put them in there, and we'll be happy to answer them. And then we also have the polls. I don't think we have any polls or poll survey questions this time. So no need to put anything there, or nothing will pop up from there. And then we have the chat. In the chat, if you got questions to communicate with the moderator there, which is Enid, she'll be happy to answer those questions and get you the information you need. And last but not least, if Diego happens to become boring or you don't like me whatsoever, feel free to leave the webinar, and hopefully we get to see you another day. And guys, this event is for you, so we encourage questions. We have people around the country, and you know, in this business of real estate, there are many different markets, many different types of investing, and many different opportunities that we can embark on. So ask questions. It might shine a little bit of light to your avenues of business. For those of you that don't know me, my name is Diego Mello. I've been investing in real estate since May of 2012. And prior to that, I was an asset manager. So I do bring to the table the financial perspective of investing. It's something that I like to tell people is, numbers do not lie to you, emotions do. So at SVI, we always are a number-based company in which we like to follow every transaction based on numbers. We've bought properties without even knowing what the front door looks like, guys, because the data is the data, and the people we work with are the ones that reduce the risk or mitigate the risk to our transactions. I was born in Colombia in South America, moved to the age of 4. Live in Houston with my wife, Kate, and my son, Aiden. My son is, and I always tell people, he's going to LSU. Actually, we're dropping him off this week, so we're going to see how that drive back home is going to be, but we're super proud of him. And again, Aiden, as we always say, we love you, man, and we're super proud of you, buddy. In 2014, I created the platform, which is StrataVentures today. So I started investing in 2012. From 12 to 14, ups and downs and hiccups, and trying to figure out there's got to be a better way to practice real estate. And in 2014, I took apart the whole machine and started putting together an implementation team based on risk. From that point till now, we actually have literally exploded around the country. COVID, or this past year of having to everybody meet via internet, Zoom sessions, team sessions, it's really helped us reach more people around the country, because financing, mitigation of risk, and numbers can be handled around the country. So that's the message we're bringing. We're very proud to know that we're in about 19 states now and growing. Getting the message across isn't really that easy, but we always love the fact that people are joining us from around the country, and we want them to get to know us every step of the way. And again, StrataVentures, for all of you guys that know us, our motto is, it's a win-win or we don't do it. And that's as simple as that. Is if nobody is going to have an equal share of the earning, not total profit, but I mean, if it's good business for the seller, the wholesaler, the realtor, the lender, the title company, the contractor, if everybody is making their share of business without discounting each other, at that point, we've got a good business model. And that's what this business should be about. I want to sit and chat with each one of you that is new. You feel free to reach out to us at investorrealestatetraining.com. And you can sign up and register for our one-on-one sessions having to do with each one of these topics. I guarantee you, you're going to leave with amazing information, whether you work with us or not. At the end of the day, we want to make sure that you know what's going on out there, what kind of tools are available, what kind of people are available for you to work with, and know that whether you need us now or later, we're always going to be here for you. So reach out for these one-on-one sessions, guys. You can find them at investorrealestatetraining.com. All right. So today's topic, guys, the BRRRR method. Otherwise, most people say BRRRR, it's not that it's cold outside, right? It's more that this market is so hot right now that because of it, it's allowing one thing to happen in an explosive manner. It's called equity. If we're not buying properties and renovating them and taking advantage of the sale value now, that means we are going to be missing the boat when it comes to having lenders lend us as much as they can where we don't have to bring any money. That goes the same for renovation, goes the same for new construction, and which is what we're going to see here. By definition, for those that don't know, buy the property, renovate it or build it, rent it out, refinance it, and repeat. Ideally, your only holding costs on a renovation are going to be the money you need to do your hard money loan or your renovation loan. And also know that if you're going to do it for a new build, there is a period of time in which you're going to be having to hold an asset, which is where you need to gain patience, because that's where the planning and the permitting comes from, and then starts the building process. Those are going to range anywhere between 9 to 12 months on the safe side. So that's where a little bit of patience needs to come in, guys. Either or, there's availability of land and there's availability of properties out there if you're going to move these into a passive income environment. And that's where the BRRRR method comes from. What to expect from this strategy, guys? Well, the rehab and new build rental strategy is actually one of the fastest wealth building strategies. The simplicity of it is that because the equity is being increased from the action of buying, renovating, or building, and then creating value, the lenders are giving you loans based off of that new addressed value. That's less money you have to bring to the table, which means more money stays in your operating capital or stays in your capital reserves. Lenders love that. This week, I had another amazing meeting with Rick Bressler from Katie Capital Investments. Him and I were talking about the many different ways that we can help our SVI members and other people around the country and putting them into amazing products having to do with the renovation to the long-term mortgage in order for people to be able to buy more. So if you want to know more about Katie Capital Investments, send us a message. We'll be happy to work with you and get you in contact with Rick. He is an amazing company. His company is amazing, and his team is all family, guys. So they know. I had the privilege to go visit them this past week, and it's Rick, the family, the team, and as he said, the dogs run the show. 5 of them, guys, are running around that office, but it's a really good environment. They're about success. The strategy allows for minimal capital to be deployed and recycled repeatedly. That's where the wealth side comes in, keeping the capital and repeatedly putting it to work and getting it back. And using quick leverage loans such as private money lending and hard money loans can multiply your cash on cash returns. Having minimal amount of money in an asset is appropriate. Having a large amount of money in an asset may not be. And I'll show you in the deal analyzer today where those numbers can come to play, because you want to be able to buy more properties, which is to mitigate and spread the risk of your overall investment in multiple properties. A few key points to think about, guys. Always use a realtor and get MLS comps. Your lenders are always going to use MLS comps. So when you're putting together an opportunity, get a realtor to help you with the comps. If you're looking at a renovation, get ARV retail comps, but also make sure to get your rental comps. You don't know that during the time of the renovation, you may end up going left on the retail sale to capitalize like right now, or you may go right to go into the passive environment, which is to take advantage of that equity. But you got to start from an appropriate starting point. And guys, that appropriate starting point is an MLS comp. Make sure not to overpay for the property. Well, that's why you have analyzers. Our analyzer is amazing because it really dictates, with all the costs associated to a deal, what you should not go over. And guys, that number, and every SVI member knows that percentile is 75%. 75% cost of value is what's appropriate to make sure you can start this process repeatedly. Confirm repair budgets with contractor and add an overage contingency. 10% is about a great overage contingency, guys. That may be from your contractor numbers, that may be from your contingency factors of risk, but also know that sometimes your lenders may add additional contingency factors. So remember to ask that lender, are there any additional contingency factors? You've heard of the golden rule, right, guys? And if you haven't, here it is. He who has the gold makes the rules. So be prepared for possibly bringing more money to the table or talking to that lender and finding out how you can come to a happy median on repair budgets and address if there's any additional contingencies. Market ARV changes may occur during your project. They will occur during your project. Just because you quoted an ARV or an appraisal at the beginning of your project, you need to be checking the monthly conditions of your environment, of your market. Market values may go up, market values may go down. Some areas that are hot may start to slow down, creating a little bit of a speculation factor. And that normally happens because people will say, oh, it'll come back in the next 6 months. Well, guys, we really don't know that, right? So we got to be very careful with that. Consider pet deposits for tenants with pets. All right. Pets, family. Kids, family. Both, we know what they do, right? They could possibly destroy a property. So if you're looking at somebody to take on pets, which makes you a very desirable property nowadays, you might want to start thinking about considering pet deposits for certain weight limits. The rentals that I have, I don't allow dogs over 45 pounds because the units that we have hardwood floors that were finished, and anything a lot heavier running around that house, you can imagine those nails become chainsaws or bandsaws just going through the floor. So try to get yourself, set yourself a parameter and a guideline and stick to that, but stay pet friendly is a good recommendation. Interview and work with a good property manager if costs allow. There are property managers everywhere, guys. Interview them and make sure that they have a systemized approach to doing this. It's not that they're taking on the whole role. You have to be very careful because a lot of realtors will take on the role of project management in order to obtain fees, but at the end of the day, they're the ones wearing all the hats. That is where things can happen because now delays of customer service, delays of repair, and most of all, at the end of the day, those delays mean more money, more damages, and a bad taste in your overall tenant to landlord relationship. So make sure you're working with a good property management company. We have an amazing management company that we use, RPM Avitus. Troy Espinob, you can find his information in our member center for those of you that are members. But if not, feel free to send us a message and we'll be happy to get you his contact information. If you're self-managing, you can also use platforms like Cozy.co and Rentometer. These are platforms now that are all based on your phone. You can actually trigger in there the path and how do you want to systemize and customer service the responses to your tenants. And it makes it super easy for you to start managing your property on a systemized way. So take a look at those such as Cozy.co and Rentometer, and there's a lot more. People that are going to recommend some of these or new or other types of software, make sure they've used it. We've used it. We like these two, but don't just take somebody's opinion for granted. Ask, dig in deeper why they like it, and then go directly to the source and find out if that's something you guys are interested in using. Always properly screen your tenants. The rental properties that we have our real estate agent screen the tenants, right? Because at the end of the day, the relationship, once the agent or our property manager leaves that equation, the relationship is between the tenant and myself, let's say the landlord. If we from the beginning are becoming a little bit hesitant or a little bit abrasive, trying to come to an agreement, this whole relationship might start off on the bad foot. Why not have an intermediary or somebody in between as a moderator, which can take all of the hits, you know? Not saying, you know, have your agent blow up or anything, but have that person be the buffer. So now at least that tenant knows that it's an industry criteria. You know, it's more not a person-to-person factor, guys. Trust me, your tenant needs to be okay with you when the bad things happen. You want them to call you for help, not call you to say negative things, guys, okay? Always be that helping person. Interview conventional lenders and non-qualified mortgage lenders. If you're thinking about getting into the realm of renovation, if you're thinking about getting into the aspects of refinancing properties, you gotta be able to understand that you qualify for the upfront mortgage or hard money loan, and you gotta know you qualify for the back-end loan, which is predominantly called a takeout loan. Without one, you don't have the other, guys, because how are you going to long-term finance a hard money loan or a construction loan at higher rates in a short period of time? It's just not going to happen. Rick at Katie Capital Investments, more than happy to explain to you the full process. They have good rates and good terms. For some of our national listeners or national members, we definitely have Trident Capital, who's helped us. We'll be more than happy to connect you with Michelle England. She's been amazing and helped a lot of our members. And be sure to have adequate cash reserves to sustain the project. Your lender wants to know that you have the ability to sustain a project in case anything happens. Usually you want to make sure you have about 1/3 of the renovation budget in reserves. That is a pretty adequate amount to have in order to encompass some, you know, lending reserves, down payment reserves. And I'm saying this, guys, is because it's going into a rental property market. You have an exit strategy already approved when you qualified for that long-term lender. That's why your lender isn't really being that hard on you with those reserves. So remember, this is all about the exit strategy. Let's see here. What are we going to learn today, guys? Investor rules to follow, key points of market area data, real estate pyramid for buying, who should you have in your team, steps to follow in your due diligence, and then we're going to go into 2 deals, one of them being a renovation to rental, and then a new build to rental. Okay, so let's get started. Every investor that is a member of SVI is from day one taught these 3 rules, guys. If you're not a part of SVI, we invite you to come get to know us. But these 3 rules should be applied in any transaction that you're wanting to go to, whether it's an exit strategy of retail or it's an exit strategy of passive income investing. First rule always, after repair values are higher and repairs are lower. What does that mean? Anybody, a seller, a realtor, a wholesaler is bringing you a deal, there's always going to be issues with the after repaired values that they give you are higher than what they really are. And the repairs that they say are actually lower than what they really are. So always apply rule 1, and then you're going to have your thinking hat on, guys. Once you validated your repairs, validated your comps with professionals, then you got to start looking at project cost. Rule number 2 is your project cost should not exceed 70% if you're looking to borrow hard money. Remember, guys, this is a short-term approach from acquisition to refinance. Is about a 2.5 to 3 month project, okay? Some lenders require that you have at least 90 days to meet in order for them to give you the value that you need so you can actually refinance this. So that's why we say about a 90-day project. Within that time, the lender who's going to literally lend you this money is going to want to know that they're not lending above a threshold of 70%. If your lender's not lending you more than 70%, we shouldn't be borrowing more than 70%, right, guys? So try to make sure you keep your lending money less than 70% with a hard money lender. If not, do not go hard money, guys, because you really don't know how long this might take. Hopefully the 3 months. And last but not least, guys, don't be greedy. That's rule number 3. At our office, we've got members that come in all the time, and I'll yell out from my office, what's rule number 3? And they'll say, don't be greedy. And then don't be greedy, guys, appears in 3 phases of your project. The first phase is when you're buying that project, right? If your deal analyzer says no more than 100,000, then the wholesaler or seller says, give me 110, it should stop right at the $100,000, guys. Oh, but it's only an extra 10,000. That little devil here right now is causing you to move into the greed field, which at that point, you don't know what the future of this project is going to be. Stick to your numbers. The second place greed is going to appear itself, guys, is going to be while you're renovating it or building it. You're going to periodically see that you're coming on budget, staying within schedules and timelines, and then you might have additional money. Well, what do we do with that additional money? Oh, let's add a backyard barbecue or kitchen area for more sizzle. No, the comps don't say you need that. Don't put that in there expecting that if you put more in there, it's going to give you more money. No, stick to the comps, take that additional surplus of money, put it to your bottom line, guys. Any additional money is going to really allow you and help you move in a safe pattern. And the last part of rule number 3, which is the selling side. If you're in and out of a transaction, guys, within 3 months, you're working on a phenomenal velocity of money. That means you started it, finished it, got an offer within 3 to 4 months. Your operating money can now start to be recycled at a level of about 3 to 4 with the same money per year, guys. Think about that, per year. It's like taking on 3 rental properties with the same amount of income in 1 year. That's unheard of. A long time ago, people couldn't do this. The lending numbers, the philosophy, the strategies weren't there. So people were giving 20, even 30% down to park money there. And then eventually they'd have to go to work and get some more money so they can go do what? They can go put it down on another property. So they were growing 1 rental property every year, every other year. Guys, you now have a velocity of money calculator, and we teach that at SVI because it's about gaining as many properties as possible. So don't forget the 3 rules, right? After repaired value is higher, repairs are lower, project cost over 70%, don't go hard money lending, don't be greedy, guys. When we're looking at a property, some of you may have seen this already that are members. When we're looking at a property, we have to make sure that we're investing in the right area first and foremost. People buy area. 2 main drivers are going to be schools, right? Education and retail. If you have a high marital status rate, you're going to see more stability, and higher marital status rates have kids. Kids cost money, guys. And when you have kids that cost money and they buy things, better retail tends to go to that area. And when you have better retail, there's more taxation, more development, more community projects, which starts to draw more ownership. So your second factor is the rental to owner comparison. If you're in an area where there are more owner than rental, you're going to have higher and faster appreciation. People buy and sell properties nowadays every 5 to 7 years. That means properties and comps are constantly coming online, which is evidence that we have that there's a market value to your property. If you're in an area where there are more rental than owner, you're not going to see a lot of comps. This year and last year were 2 of the highest recorded refinancing years in history with the lenders, because there were more people that were passive income borrowers refinancing their properties. That's not a sale, guys. That's an internal refinance, nothing that'll appear on the market as evidence of sale. So think about this now, guys. We're entering and we are in a seller's market, if you really want to think about it, but it's not as heavy as if it were a refinance market. So we are still at a level in which there are still good opportunities to land good properties in a good area. So don't forget, occupancy comparison is going to go either rental, or are we going active and retail, selling it flips. Look at your school district rating. Your school district rating, guys, is going to be probably the one that best dictates this, because you have taxes that are based off of the school, more desirability. So the higher the level, the better. Then you have your seller indicator score. That is going to be, again, what drives desirability. That seller indicator score in many different markets, California, all the way to New York, to Florida, to Arizona, to Illinois, there's always going to be a realist report or an equivalent to the realist report that gives you these 4 factors, guys. Your seller indicator score, that's desirability of your property selling within a 6-month period. Your school district rating is going to tell you where does that school district stand based off of, families wanting to put kids in a better school. Your occupancy comparison is going to dictate at that point, are you going rental? Are you going owner? And last but not least, your marital status ratio. If you look at an area and all of these things are a hit, you have 4 check marks, 4 stars. Anything literally in that market area is going to work if you buy it correctly. Think about that, guys. You bought the area, you went to the zip code, you went to the neighborhood. There were only 2 houses left in that neighborhood, and you had to pick those 2 houses. So was it really the house? No, it was the area, right? It was these market factors that allowed you to move into a better investment. The other thing here, guys, that we teach is staying on track with your median home prices, your median home market prices. Every market in every city in the United States has a high and a medium market price. Stick to your median home price. This 288 right here is a number that tells us that 60% of the people in Houston, San Antonio, Dallas are looking for properties in this high effective number of 288. If you decide to go higher on the after repaired value numbers or comp values, you're going to lose 50% of the people looking for properties. Think about that. You're a store owner, you just raised the price by 10% of your merchandise. You lost 50% of the people there. What's going to happen to your inventory? It's going to deplete itself. It's going to expire. You're going to have to throw it away, and it's going to cost you more. Then you have, on the other perspective here, you go to the lower price point. You are going to have more people wanting to buy that property, but then you're going to have now a separate group that may not qualify for a home mortgage. Home loans now are starting to get a little bit more rigorous than back in the 2006, 7, and 8 days. We know what happened. So lenders started to really squeeze on requirements. They're starting to get a little bit more lenient, but it's not the same as the Wild Wild West back then. So if you have a property that somebody who's a new home buyer, they love it, they get it under contract with a pre-approval contingent on these other things, you've just taken your house off the market. What if they can't get to the closing table? You got to put it back on the market. Now you've wasted another month. Now your property may show terminated, expired, back on the listing, which then now realtors can pull that history, and now your property has a big no-no on it that is false because it's not the property. It was actually the buyer. And if you guys are looking at properties that are about 15% of the prevailing market rate prices in your area, the median points, you got to start thinking that right now that property should be instantly going into your rental portfolio. Why? There are more candidates that right now, in the way the market is and the way people are seeing home ownership, more people are looking at renting properties as their starter homes. When they move from an apartment, they're renting a house, then buying a property, guys. So it's a good segue for you to have a constant supply of tenants in that property. Who you should have on your team. And sorry, guys, if I am moving a little bit faster, time goes by super fast here. Who should you have on your team? Well, everybody has a role. You need to have realtors and wholesalers, marketing for deals and making offers, guys. Contractors, you need it for estimates and repairs. Builders, the same thing for estimates and repairs. Lenders that are open to rehab and new build products. Not every hard money lender will take on new construction. So it's best that you ask, because you can also build equity and wealth on new construction, guys. And if you're thinking about doing renovation and new builds, before you do anything and go talk to a hard money lender, talk to a conventional or asset-based lender for that long-term mortgage. If you show up to a hard money lender with an already approved takeout loan contingent to appraisal, basically, things are going to go smoothly, guys, because that hard money lender is actually going to want to lend to you because there's that security or gentleman's security on the other side. And remember, you need project management companies, which are small to medium sized, to handle the rigorous property management rules that are out there nowadays. Certain steps to follow. And by the way, this is recorded and we throw it out on our Strata Ventures YouTube. You're more than welcome to go back to it and subscribe. We would really appreciate that. Steps to follow in the due diligence, guys, is number one, get your marketing campaigns out. Realtors and wholesalers are your primary. Comparable and sales study, starting price points and activity. Talk to your realtors to make sure the data that's coming to you and the leads that you're getting are within your ability of the takeout loan. You may have a $500,000 good deal, but if you're only qualified for $250,000, you don't have a deal. Stick to the price points of what the lender's telling you. Repairs and new build budgets fit and finish. Stay to a standardized fit and finish with your analyzers, with your contractors, with your builders, so you don't stray too much from acting very, very fast. That all comes from price point. That's why they call them comps, guys. Your funding, hard money lenders and private loans need to be also there, something that you have to have reviewed before you move into your takeout loans too. And also check out your exit strategy. Do we want active investing cash now, or do we want passive income for 30 years? You got to make sure you make that decision, but at 75% cost of value, what I talked about earlier, you'll get to that fork in the road and either direction is favorable for you. Your takeout loan for refinances, get your conventional lenders or your asset-based lenders. I always recommend using non-traditional banks. I'm sorry, don't use traditional banks. Use non-traditional lenders. Right now, your agencies, your Fannie Mae's, your Freddie Mac's, they're starting to pull away a little bit from the investor world because the COVID, what happened with COVID really gave them a little bad taste. So it's great that you start to look at non-conventional lenders because there's a lot of great products and a lot of good rates out there right now. So look into those, okay? Here are some of our partners that I want to thank before we get involved with our deal analyzer to look at. We have Hearth Finance. Guys, if you go to Hearth Finance, they actually have the lending capital for renovation. Guys, they'll give you the renovated loans, 5 to 7 year terms, no prepayment penalties, rates as low as 5.875, no second liens required. Ask us anything you want about any of our vendors, because these are vendors that we trust. These are vendors that have worked with us, and these are vendors that we will absolutely recommend because we're in great partnership with them. All right, let me move here into the deal analyzer. If anybody has any type of questions, feel free to put them in now. Let's see. Lynn said, oh, and if you don't mind, guys, please put your questions in the Q&A. To do a rehab to rental usually involves two lenders, one to purchase and to rehab. A second one for the hold. I have seen a few of them offer both for a project. What's your insight on the two? Absolutely. Trident Capital is used right now. We are doing transactions with them. It's called a one-time close, or known as a construction to perm, because the construction to perm is favorable. Less closing costs, right? And they already have your data. Let's see, Martinez, please mention examples of additional contingencies set by a lender such as hard money lenders. Each lender is different. They'll have contingencies based on reserves for down payment or monthly payments. There'll be reserves of escrow tax collections. There'll be contingencies on amount of draws, and also contingencies on the amount of reserved capital you need to have as a whole. Ask your lender and let them know, and then fit that box first, and then everything else they'll be able to work around that, guys. Let's see here. What do you think about 3-story new townhome builds inside the loop of West downtown Houston? Is this built to sell market or more feasible for buy and rentals? That's a great question. Right now, if I were to get into building 3-story townhomes, subdividing, high density building, have a mixture. Sell a couple, keep a couple. I have that on some of my projects. Price point 650 to 800,000. Those are rentals. Because right now, people don't want to be buying at such a higher number, but they are willing to pay the rents, guys. So have a mixture of it, okay? So that was a great question. All right, let's get started here on the analyzer. First, we're going to do the numbers based off of a renovation to rental. So let's say hypothetically, we have valid numbers from our due diligence. And I'm putting in some numbers here for you guys to see. And I'll explain those here in just a little bit. Oops. Okay. All right, the numbers that I just keyed in, guys, are in the yellow cells, and all of this is going to move over here to column C. Our most important number of all is going to be this column right here, the cell C27, which is our cost of value. How do we get to the cost of value? Well, let's see here. Add cost, guys, with our SVI analyzer means appraisals and inspections. We need to account for those. Taxes, 1 whole year's worth of taxes, let's say 5,500, and where do we get that? From the corresponding tax authority. Closing cost, we have built in 3.5% for closing, even though some of your standard closing is actually at 2%. Well, we actually put in more there because a lot of wholesalers say that we, the buyers, have to pay for closing costs. After repaired value, purchase, renovation. All of these numbers together equal the purchase, the add-ons, taxes, and closing costs, which are the addition of this and this, means our total acquisition is $145,975. If our full acquisition plus repairs of $45,000 is $190,000, this on paper is going to look like the confirmed comp of $250, $190,000 for total project cost. If you go to your lender's going to look at you and say, let's get an appraisal. Everything is based on appraisal, guys. So let's say your appraisal hits 250. 190 to 250 means this is a 76% project cost, guys. 76% project cost. That is still allowable. Why? Because when we move our calculators over to our hard money lender, we're going to look at this and say our hard money lender is going to lend us 11 to 3 months. They're going to lend us not the $190,000, guys, because that puts us at 76% cost of value, which means we'll break in rule number 2. They're going to lend us 90% of that number, which happens to be 171, which means we're bringing 10% down. From this 10%, the loan of 171 now happens to be 69% loan to value for the hard money lender. So we're safe. We're not breaking rule number 2. This 171 at 11% is $1,500 a month times 3 monthly payments is $4,727. This loan amount at times 2% in points is another $3,400. This makes this $27,262 that you have to have in readily available capital. Okay? What happens when we're ready to hit our exit strategy on whether active or whether rental? Let's look at this as a rental. You are going to now take this number to your long-term mortgage holder or whoever you got approved for the long-term mortgage. And I divide these 2 sections, the acquisition and the repairs, in 2. Why? Because sometimes people like to bring their renovation cost cash because they're going to get it back and they save themselves a certain cost of money. If we're buying the property at 145 and we're renovating it with 45,000 all under one loan, we would be charged for 3 months $6,900 for the purchase and $2,100 for the renovation, guys. At the end of the day, the total amount of money that we have that we owe or that's invested in this project is $200,046. You guys remember that the project cost was $190? Well, what we're doing right now is adding this $6,900 and this $2,100, so that's where we get $200,000 as a payoff to the project. If our hard money, if our long-term lender states that they need to lend 80% of the appraised value, guys, we don't need any down payment for this. That is great. We are completely now taking back our investment of the cost to rehab this, and we're going to borrow $200,000 at 4.875, which are rates that we're getting right now, maybe even lower, for a 30-year mortgage. And you now have $5,500 in annual taxes, means $458 in escrow. Let's say you have a homeowners association and you have $1,400 in homeowners policy. So the principal and interest payment at 4.9 for 30 years comes from a loan of $200,000 plus $458 for monthly taxes plus $550 for the HOA cost, which is a monthly breakdown. And then you have your annual insurance divided in a monthly breakdown, leaves you $1,680 a month. Let's say for this particular property was $2,000. That means you're collecting $24,000 in annual rents, $20,000 in total expenditures, leaves $3,845. That $3,845 divided by 12 is $320 a month in positive cash flow, which means your $6,000 of what you used, what you invested was the closing costs for your long-term mortgage, right? Because they don't do that for free. This is a 64% rate of return on your investment. Somebody's going to say here, Diego, well, what about vacancies, right? What about maintenance and what about all of that? Well, I usually like to take out about $1,500 annually on a property of this number, because remember, you renovated this property because you should be out of your investment in about 3 years this way. Your investment was $6,000. You took $1,500 out every year, which left you $2,300, which is $195 a month. I know this may not be a lot of cash flow, guys. The point behind that is that this property becomes 100% on its own in less than 3 years. Look what happens if you raise the rent by $100. 2 years. You guys follow the strategy. The strategy is this thing is self-functioning and your investment is out, and it was minimal investment, which means let's go do more of these. And now your property is functioning and your rents start growing. Okay, just wanted to show you that. It's not to think you always have to be putting capital into a property. That's why the more money you put in, the worse your returns are going to be, but you're going to have less amount of money to put into the next properties. That's why we're saying don't use your traditional lenders, use some of your non-recourse type lenders or some of your other type non-conventional lenders, because there's no limit to what they're going to lend you guys. So I hope that was great information. I'm going to move over now to the new build side. Let's say we're building now a new property. New builds kind of work backwards. So there's always going to say there's architectural and engineering cost. There is a full annual cost of taxes. Let's say you're building a 1,900 square foot property. Let's say the build cost to build that is around $115 a square foot. Oops. And you have site and development. Site and development are all of your soft costs, things such as tearing down a property, permitting, all of those additional numbers. Let's say for a number, let's say $6,000. The next thing that you have now is you have all of your soft costs here are at 14,000. Your build cost is 218. So your total project cost now happens to be 232,500. Even if somebody gave you a piece of property free, if your ARV happened to be 75% of 232, so let me just look at this number right here for a moment, guys. Make sure my calculations are right. If 232,500 is your total project cost divided by 0.75, you need to have an after repaired value of 310. But what's missing? The land, right? We do need that land to build, right, guys? So right now, if the comps happen to be 350, it's letting us know that at a 70%, your land allowance is 17.5, and your maximum 75% happens to be $30,000. Always run your numbers and make sure your land is the last thing you look at. Don't make the offer and buy a $10,000 inexpensive piece of property and buy it, because at the end of the day, the ARVs, the build cost may be what keeps you from building on there. That's why, guys, sometimes you see empty lots that stay empty for a while in certain neighborhoods. It's because nobody can build on it because the values in the neighborhood haven't hit and the build numbers are still a little too expensive. The same thing works in the new construction side as if it were the renovation side. Why? Because now we're looking at these numbers the same manner. 11 to 9 months, obviously, guys, because we're looking at a bigger construction number, longer hold time, right? Because we're building. This now means your total out of pocket is $50,667, because as long as we stay below 70 on the lending, 75 or below, we're close to that on the project cost of value. Right now on a new build, the most you're going to need to bring is right at around 3 to 4%, guys. You are going to have to bring on new construction some money because of your extra hold time. It's not as fast as if you were doing a new build. But remember, we started at $350,000 at the beginning of the project, right? If 9 months have gone by and this now says that properties are selling for $375, now let's look at what you need to bring to the table. 0. You're actually going to get some cash back, guys, because the time of the construction has allowed the market to shift and the market to start appraising, the market to give you better comparable values. I don't know if you guys know this, but areas where there's not a lot of building going on, if there is some building happening, jump in there, guys, because those sales are starting to drive up appreciation, which means that later on, you're going to get more appreciation on the back end where you bring less money. Let's see here. Let's say the same number here at 4.875, 30-year mortgage, HOA, property, homeowners policy. Let's say your rents are going to be $2,500, hypothetically. Notice the same outcome. It's having a higher rate of return, so faster you start to obtain your capital back so you can do more. All right. I know we're getting short on a little bit of time there, guys, and I would love to talk to every single person that goes and reaches out to us. I know this is a lot of information. We would love to send you as much information as we can. We'd love to talk to you. But let me answer some questions here, if that's okay. And I hope the information was good, guys. It's a lot. Let's see. Somebody asked, how closely linked are you to Anderson accounts? A little, what do you mean on that? If you don't mind chiming in on that one. How do we acquire financing for the BRRRR investments, specifically for a multifamily 2 to 4 unit? That's a great question. Give us a call. You can ask any lender because 2 to 4 units is encompassed as a one lump sum escrow account for the build or for the renovation. They're also going to look at each individual unit and see what each individual unit is going to perform at because you happen to have better amenities on the other one. Let's see here. What are some good strategies to pay off the BRRRR faster? To pay off the BRRRR faster? Well, yeah. Number one, this is making it's hit on you because you're getting your investment back. Great. The other thing is constantly sending additional capital to your principal. But then at the end of the day is, why did you do this if it wasn't for cash flow? Usually about 15 to 20% allocation every month towards your principal balance is going to shave time, and it's also going to shave off your interest rate. We have an amazing calculator called the Terminator. And that Terminator is going to tell us that if you allow an extra $250 to $300 per payment, it's going to tell you what your overall total interest is paid off on, right? The bad thing about most rental properties or rental scenarios is that you have too much money sitting in here. Then you start to look at your cost of maintenance. Then obviously your interest starts to hit too, but you're not appreciating. You're constantly going to be hovering in a, not wouldn't say a bad performing investment because you have cash flow, but not an overall win-win because you're still paying a lot of interest. So I'd love to talk to you about that. Those are great questions. Did you state working with unconventional versus conventional loans? Yes, yes, Miss Anna. Working with your non-conventional mortgages because it's become so active right now in the private equity in the non-conventional arena. There are some amazing incentives and amazing benefits with working with non-conventional lenders. We'd love to send that over to you. Look at that. Look who showed up. Rick Bressler, my friend. Katie Capital Investments can fund 1 to 4 units and 5+ units. Rick's phone number is 281-851-3867. Enid, could you post that out there to everybody? Awesome, Rick. Good to see you. And let me get back over here. And let me stop the share. And give me one moment, ladies and gentlemen. If you want to get a hold of me, here we go. Guys, we are constantly meeting with people, helping people, having a ton of people ask us questions. We're so fortunate to be able to help as many people as possible because we want to help people start off on the right foot. You can reach me directly to 832-213-7155. You can also email info@strataventures.com or go to investorrealestatetraining.com, and you're going to be able to see everything that we do. Also, don't forget to ask us about the private money lending platform we have. For those of you that are getting started right now that have capital, Let us show you how to put that PML to work with low risk investors that we have, and you'll start to see positive cash flow in the PML side. For those of you that are active investors that are looking to buy and start flipping properties and don't have that capital, you need to call us because we have PMLs that are ready to invest in you. Feel free to reach out to us, but call me directly or call the 800 number, 800-504-2909, or visit our webpage at investorrealestatetraining.com. And Enid, Oriana, always thank you guys for all the work that you do. They always tell me, like and subscribe and go to our social media pages because you can get a copy of this. All right. So any more questions while we close out the session here? Let's see. Oh, Martin said, when are you holding in-person classes back again? Good question. I love holding in-person classes, guys. Unfortunately, we're not back to that. We were right about the time to start doing them again, but I love the in-person classes that we have at all our offices. Right now, all the classes are being held online, but the good thing is you have your learning management systems. You also have all your recorded sessions, and all of that now becomes very, very active for you because we're constantly pumping new things into that system. So that's a great question. All right, so anybody else have any questions? I'd be happy to answer for you. Let's see here. That was Enid. Okay. All right, guys, don't forget to go to investorrealestatetraining.com and check us out. Look forward to working with every single one of you. I want to thank all of our vendors for working with us and making a lot of success stories with our Strata Ventures members. And with that, I look forward to seeing you guys at our, not next week, but the week after that. That's another industry webinar that we have. Go to our social media, go to our investorrealestatetraining.com, and you're going to be able to see what's coming up. All right, you're very welcome, guys. Those of you that are saying thank you, and look forward to seeing everybody. Tal, always good to see you, sweetheart. I'm going to be calling you here soon because I think I've got a good contingency plan for you, sweetheart. All right, have a wonderful evening, guys.